The outlook for emerging markets. Our latest global liquidity data shows that overall liquidity for the world economy remains buoyant. Our index at 60.8 for the last month actually disguises, though, a significant divergence between emerging markets, where the index level is only 16, and developed markets, where it's as high as 70.8. This divergence is unusual and particularly wide at the current point. The reason can be traced back to what's going on in China. There is a mistake in many investors' eyes that emerging markets have weakened largely because of the prospect of an upcoming tapering by the US Federal Reserve. That is just not the case as far as we see it, largely because if you look at a counterfactual, frontier markets, currently pretty buoyant, they've outpaced emerging markets through this year, and they will likely be even more disrupted were tapering likely to be a negative feature. It's China which is the more important factor. And in fact, to extend the analogy, one may even say that the prospect of US tapering this year is far less significant than the reality of Chinese tapering by the PBOC last year. It is that tapering by China's PBOC that is crushing the Chinese capex cycle. That China capex cycle has propelled emerging market economies for much of the last 10 years. The weakness that we're currently seeing in Chinese capex is feeding back onto weak private sector cash flow growth in China itself and spilling over into the emerging economies. Private sector cash flow growth is very weak across the emerging economies, with the one exception perhaps being the African region. Latin America, emerging Europe and emerging Asia, ex-Japan and ex-China, all have very weak private sector cash flow. That is likely to mean that growth in these economies is below expectations in 2014. It is also likely to mean that currencies for these economies will remain fragile. Currency markets tend to get most of their impetus from the strength of private sector cash flow growth. They tend to be strengthened by this so-called good money, and currencies tend to be weakened by central bank money injections, which we dub bad money. The good money, bad money difference is really what drives forex market risk. And what you're seeing right across the emerging world is actually fragile currency markets, because good money flows are weak and bad money flows are picking up. Therefore, although looking on a 1 to 2 year view based on very low current investor exposure to emerging economies, one would, as a contrarian, recommend purchase right now. On a shorter term view, of maybe a 6-month view, we still believe that caution is required. Therefore, we would only put a toe back in the water in emerging markets at this stage, maybe build a third or a half position before getting the comfort or reassurance of currency strength and a revival in private sector cash flow growth, maybe over a 6-month period, before we would start to re-enter. Otherwise, emerging markets, if you do go into them, focus on the US capex cycle, which is likely to be a much stronger driver than China right now.